world is facing a major economic challenge as debt levels have skyrocketed to unprecedented levels. The COVID-19 pandemic has exacerbated the situation, with governments and central banks resorting to unprecedented measures to support their economies. While these measures have provided some relief, the long-term consequences of such debt-fueled stimulus packages are becoming increasingly clear. As debt continues to pile up, it is becoming evident that it is unpayable, and inflation is here to stay. The concept of unpayable debt is not new. Historically, governments and individuals have borrowed money with the expectation that they would eventually repay it. However, as debt levels increase, the burden of servicing the debt becomes unsustainable. Governments are left with few options but to default or inflate their way out of the situation. The latter is often seen as the more politically palatable option, as defaulting on debt can have severe economic and social consequences. Inflation is one of the most effective ways to reduce the real value of debt. As the value of money decreases, the value of the debt decreases as well. This is particularly true in a world where interest rates are already at record lows. Inflation can also be used to stimulate economic growth, as it reduces the cost of borrowing and encourages spending. However, inflation can also have negative consequences, particularly for those on fixed incomes or with limited resources. As the cost of living increases, these individuals may find themselves struggling to keep up with basic expenses. The current economic situation is particularly challenging, because inflation is not just a temporary phenomenon. It is likely to be a long-term reality, driven by a combination of factors such as supply chain disruptions, rising commodity prices, and labor shortages. These factors have created a situation where demand is outstripping supply, leading to higher prices. Additionally, governments and central banks are continuing to pursue policies that will keep interest rates low, further fueling inflation. The implications of these economic realities are significant. First and foremost, it means that debt is becoming increasingly unsustainable. As inflation continues to erode the value of money, the cost of servicing debt will become more difficult to bear. This will be particularly true for countries with high levels of debt, such as the United States and Japan. Second, it means that individuals and businesses will need to adjust their expectations and budgets accordingly. As the cost of living increases, they will need to find ways to reduce expenses or increase revenues. This could lead to a significant shift in consumer behavior, with individuals opting to save rather than spend. This means that governments will need to find new ways to stimulate economic growth. The traditional tools of monetary and fiscal policy may no longer be effective in a world of high inflation and low interest rates. Governments may need to explore alternative policies, such as investment in infrastructure or support for small businesses. Additionally, there may be a need for greater international cooperation, as the effects of inflation and debt are felt globally. Finally, it means that individuals and businesses will need to be prepared for a more volatile economic environment. Inflation can lead to fluctuations in currency values and asset prices, making it more difficult to plan for the future. It may be necessary to hedge against inflation by investing in assets that are likely to retain their value, such as real estate or precious metals. Debt is one of the most significant challenges facing individuals, businesses, and governments around the world. High levels of debt can be unsustainable, leading to financial instability and economic crisis. However, there are different ways to reduce debt, and one of the most effective methods is through inflation. Inflation can reduce the real value of debt, making it easier to service and pay off. However, inflation can also have negative consequences, particularly for those on fixed incomes or with limited resources. Inflation is a general increase in the price level of goods and services in an economy over a period of time. This means that the purchasing power of money decreases, and it takes more money to buy the same goods and services. Inflation can occur for various reasons, such as an increase in the money supply, rising production costs, or a decrease in the supply of goods and services. While inflation can have negative consequences, it can also be used to reduce the real value of debt. One of the primary ways inflation reduces the real value of debt is by decreasing the purchasing power of money. As inflation increases, the value of money decreases, making it easier to pay off debt. For example, if someone borrows $10,000 at a 5% interest rate, they would need to pay back $10,500 at the end of the year. However, if inflation is 3%, the real value of the debt would be $10,291, as the purchasing power of the $10,500 would be reduced. In this scenario, inflation has reduced the real value of the debt by $209. Inflation can also stimulate economic growth. People tend to spend before money loses purchasing power. This can help reduce debt. When inflation increases, the cost of borrowing decreases, making it easier for individuals and businesses to take out loans. This can lead to increased spending and investment, which can create jobs and boost economic growth. Additionally, higher inflation can increase the value of exports, making them more competitive on the global market. This can also boost economic growth and reduce debt levels. However, there are also negative consequences of inflation. One of the most significant is that it can lead to a decrease in the purchasing power of individuals and businesses on fixed incomes or with limited resources. As the cost of goods and services increases, these individuals may struggle to keep up with basic expenses, leading to increased poverty and inequality. Additionally, inflation can lead to uncertainty and volatility in financial markets, making it more difficult for businesses to plan for the future. Furthermore, inflation can be difficult to control. Once it starts, it can be challenging to stop, as it can become self-reinforcing. As prices increase, individuals and businesses may adjust their behavior to take advantage of the higher prices, leading to further inflation. Additionally, inflation can lead to an erosion of confidence in the economy, leading to decreased investment and economic growth. Despite these challenges, inflation can be an effective way to reduce the real value of debt. However, it is essential to consider the potential negative consequences and weigh them against the benefits. Governments and central banks can use inflation as a tool to reduce debt, but they must also be prepared to manage its negative effects. In addition to the potential negative consequences mentioned earlier, inflation can also be viewed as a tax on the poor. This is because those with limited resources, such as low-income households or pensioners, are often the most vulnerable to rising prices. As the cost of basic goods and services increases, these individuals may struggle to make ends meet, leading to increased poverty and financial hardship. Moreover, inflation can have a regressive effect on the distribution of wealth. The wealthy can often afford to invest in assets that appreciate in value during inflation, such as real estate or stocks, which can help them maintain or increase their wealth. In contrast, those without the means to invest may see their savings and income eroded by inflation. This can further exacerbate income and wealth inequality, as those with the least resources are hit the hardest. Therefore, while inflation can be an effective tool for debt reduction, policymakers must also consider its impact on the most vulnerable members of society. This is for educational purposes only and should not be taken as financial advice. The information provided is not intended to be a substitute for professional financial advice. Please consult a financial professional before making any financial decisions. Please, comment, like and subscribe.